Good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers, and they're on the house, coming to you from Palm Springs and the greater Coachella Valley area. Weather here is, warm, toasty a little bit, but definitely comfortable. Uh, Very high 80s, 90-ish plus, a little bit of clouds. I think we've got a tropical storm off the tip of Baja, as I recall, coming up northward here. So in any event, of course, as you'd like to know, I like to talk about the fact we're in the baseball playoffs. So we'll be sure to be done with our show before the upcoming game. Dodgers Phillies. Phillies managed to keep alive with a win. So we'll see what happens today. I do not think it's within the or outside of the realm of possibility. The Phillies might still be around for a game 5. So we'll see what happens today. That's got to mean another Phillies win today for them to move forward. All right, with that little sports report, we'll move on to the bond and mortgage market. As you know, the first thing we like to do is bring up our rate grid from our website, where you can see our current mortgage rate indications. I call them indications because these are based on general parameters as to credit score and loan to value, and every individual's terms are going to vary depending on their situation. So keep that in mind. But these are pretty good indicators. And what you can see is rates continue to be very stable. We're hovering right around the 6% range, plus or minus, on those conforming fixed rate loans and buy downs. FHA, VA is right there still in the mid 5s. The 15 year is very low right now. And those equity loan rates, by the way, at the very bottom are remarkably good. So anybody looking to been on the fence about pulling out your equity, you really ought to take a look at that. If nothing else, costs you nothing, get in touch with me. I can put together a worksheet for you to give you all the details to help you, evaluate if now might be a good time based on what the cost of financing currently is, which again is very attractive as equity loans go. So then we'll go on to the bond market. The 10-year bond yield chart that we'd like to pull up for the last 5 days runs from last Friday to today. You can see how last week we ended last Friday lower than we are now, and then early this week yields definitely did start to trend up a bit, getting into that mid 14, 415, 416, almost a 420 range. Then we had that that Wednesday dip that Jeff likes to call, but then today kind of a little bit of a trickle back up. So here we are, 4.13. What's it been now? We're going on 3 weeks ago with the Fed rate cut, where the 4-year, 10-year bond yield dropped briefly below 4 for like an hour. And by the end of the day, 408, and here we are at 413, and we've been kind of jumping around in that range ever since. I think actually all that, if you kind of put it in plain language, all that's pretty good in terms of stability. I think that helps the market overall. I think people are getting more and more comfortable with rates are what they are. Start working on that home price, because I think that's really where the issue is in terms of affordability, or the primary issue at least. I think mortgage rates are really secondary when you consider what's affecting affordability the most. In any event, again, relatively stable on rates and on bond yields, and I think that is a pretty good thing. Now, what's going on in the markets this week to help shape where the bond yields are at and where mortgage rates are? Well, when you got a government shutdown, there's not a whole lot to talk about. There's a light calendar week anyway for economic data points. But then when you have a government shutdown, what does that mean? Some of those data points aren't being released at all. As you know, we didn't get the employment numbers last Friday. That's the unemployment rate, the number of new jobs created, private and public. That wasn't released. This week, we're running into the same issue. Initial claims for unemployment was to be released this week. It has not. Again, part of the federal shutdown effect that we are having on at least the markets in general, if not the mortgage market specifically. So as a consequence, what was interesting in looking at the U.S. economic calendar, which is something you can Google it, pull it up, and when you look at it, with the lack of other, a light data calendar anyway, and then some of that data not released because of the government shutdown, the calendar was really pretty much full of what I call Fed speak. We had a multitude, I think by my count, 8 governors, as well as Chairman Powell, all scheduled to speak sometime this week. It's important to note only because especially when you have this lack of other data, this government shutdown, then to that extent, that data not being available, the market's going to start looking to react to something else. And that becomes looking at all of these interviews, speeches, whatever they are, lots of people in the Fed all talking this week to try to gauge what's their overall focus, where are they starting to trend to in terms of labor market, inflation, is there chances of more rate cuts than currently predicted, that kind of thing. So that's really, to the extent we're going to have effect on the market and mortgage rates, that's really what it's all about. And one of the other little bits of data that did get released was the Federal Open Market Committee minutes from their last meeting, the meeting just, 2.5 weeks ago, when they lowered that Fed funds rate 0.25%. So the minutes to that meeting were released, and it did bear out a few things. First of all, the Fed officials strongly are inclined to lower rates further. The argument is how much and how fast. How much each cut and how fast will they start doing that? In fact, right now, or at this meeting, it came out, there was a 10-9 vote for 2 additional rate cuts for 2025. And those are pretty much agreed to be 0.25% cuts. So by a slim margin, 10-9, the Fed participants voted that there should be at least 2 more cuts, basically the 2 last potential cuts of the year, October and I think December. So, and those are expected to probably be 0.25% each time. So if you're on a HELOC, if this bears out, by the end of the year, your HELOC rate is going to be 0.5% lower than it is now, which is 0.25% lower than what it was a month ago. So you'll have that 0.75% improvement on your existing HELOC from the last month's cut through the end of the year if this bears out. So that's good news for you. And if you're thinking about a HELOC, that's a reason to start looking at these, because that means these rates are getting better on that particular product. So check it out. We can give you some numbers for that. And so the last about the Fed minutes, the FOMC meeting minutes, was they're going to continue to have some concern and focus on the labor market. So that's important to know, because if we have some soft labor market numbers come out once we are able to get data again, that could help with bond yields and maybe get rates lower. Again, unfortunately, I hate to say it, in the mortgage business, sometimes you feel like you're in a place where you're rooting for, bad economic news, because it tends to be good for the bond yields and therefore for mortgage rates. But obviously, we all know better. That's really not what we want to see happen. We want to have both. We want to have those issues be addressed as they should be. At the same time, we'd like to see rates get lower. So with that, we're going to go ahead and bring Jeff on. We're going to do some little bit of a discussion, primarily about, so with this government shutdown, what does that mean for the mortgage market, and what does it mean if you're trying to get a mortgage right now?
Art, is this like summer break and the teachers are out and they're off on vacations? There's really nothing going on because the government shut down, so you can't buy a home, you can't get it refinanced and things like that. Is that that's going on?
Well, not exactly. And that's why I want to talk about that, because if you're to focus on the headlines, it can give you that feeling, right? I mean, I literally saw the headline grab me probably 30 hours after after the deadline for the government to shut down, was when I saw the very first article about those relying on government paycheck struggling to make it. And it's like, well, wait a minute, this hasn't gone into effect long enough for them to have even missed a paycheck yet. So if this is all true, I think there's an underlying problem to this particular family situation. But anyway, so yeah, that's why I wanted to talk about this a little bit.
Well, let's talk about that. And one of the things that I was wondering is, when the government shuts down, what effect does this have on the home mortgage market? Does it affect, if rates are moving and things of that nature?
Yeah, well, it's a funny question to answer, actually, only given how long I've been around. Because again, you look at these headlines and I see some. And I've read a couple of articles about, related to the mortgage industry and what does it mean and what kind of effect there's going to be. And it's interesting because even now in 2025, some of those comments, those opinions that are out there are almost like describing an industry from when I first got in the business, right?
Yeah.
Because I saw one where they talked about processing delay. I wrote it down, processing delays. And it specifically referred to the government insured or guaranteed loan products like FHA, VA, USDA. So it perpetuates this perception that if you're getting an FHA, VA, USDA loan, because those are federally guaranteed, insured, whatever, however that's done, and they differ from product to product. But given that the government's involved, this perpetuates the perception that means it's going to take longer to get the loan and there's more hoops to jump through. And by and large, a lot of that simply is not true anymore. Now, I say I can relate to this because, 40 plus years ago when I got in the business, many FHA loans as well as VA loans weren't underwritten and approved at the local lender level. Many lenders, like the company I started with out of college, a mortgage banking firm, oftentimes we had to submit the file, the loan file, to FHA to be underwritten.
Oh, wow.
To the Department of Veteran Affairs, or the VA, as we called it back then, to be underwritten. It wasn't, as much in the lender's hands as it has been now for several decades, actually. So the notion that this government shutdown has affected the processing of new applications, people are just open escrow to purchase a home. That's really not happened. The front end of the process, the origination side of the business, which is what we're in directly, that's what we specialize in, that initial customer contact, origination step. That's where we're at. And in that part of this business, it really hasn't been affected at all. Part of these articles too talked about reduced staff. Well, again, the lenders we're delivering loans to are trying to hire staff because business has gotten a little bit better, but that's a different issue. It's not because they cut people off, laid them off, they're on furlough because of the shutdown. Far be it. Many of these lenders are looking for a little bit more help to keep up with the current volume, which again is not setting records like it was a few years ago, but certainly has gotten better than what it was.
So in that situation, when you're talking about hiring more people, so the decision process really isn't in the hands of the government. Is that already like, hey, there's this bulk of funding for FHA or VA or USDA loans that between you and your lender, that's already going to get solved. It's not waiting for somebody that's on furlough to make a decision. Is that fair to say?
Yeah, I think so. And see, again, that underscores what I was trying to describe there about how the business is different now. Back 40 plus years ago, FHA and VA would be more directly involved on the front end, the origination step, where they as agencies would be involved in performing the underwriting function. That's an important function where you have to get past that, get your loan approved in order to fund your loan. See, today, 99% of FHA, VA loans do not go to the agencies for any kind of underwritten review or prior approval, they call it, before the lender's allowed to move forward and close the loan. That's no longer how it's done. And so that's why on the front end, there's really been no effect at all. Now, where it can affect mortgage lenders is on the back end. I don't know if they still call it this now, but back in, when I first got in the business, especially for a lender who originated a lot of government loans, again, FHA, VA, USDA, they would have their shipping and insuring department. And this is where they're shipping the loan files to say FHA in order to get the FHA mortgage insurance certificate for the loan file. That's an important step so that when the lender, if they have a problem in the future and there's a foreclosure that has to occur, maybe because the borrower defaulted, that certificate is important because that means that loan's been certified by FHA and they can then submit their claim to HUD to get reimbursed for their loss from the foreclosure. So getting kind of technical there, but that's a part of the business that could be affected by what's going on now. But even that part, I would say, is not quite like it used to be. So from that overall, then about the only area in the mortgage that's kind of mortgage related are those buying a home that's in a flood zone area. There are some problems with getting, flood insurance through the National Flood Insurance Program, of course, because it's a federal agency. So that's been an issue. Thankfully, right now we don't have any loans in process for properties in a flood zone. But other than that, it's pretty much business as usual. And so, from that perspective, I don't think we really have anything to worry about, at least not yet. And then if I can add one more thing, here in our local market here in Palm Springs, Coachella Valley, this was always an issue with the BIA, the Bureau of Indian Affairs. In the past, the BIA would end up being sucked into the government shutdowns that we've had in the past. Well, we lobbied hard on that here in the local association, Realtors Association, but that didn't seem appropriate because, after all, technically, the Bureau of Indian Affairs, that they're basically governed as a separate nation, right?
Right.
So how is it that the U.S. federal government is having an impact on what is supposed to be separate from that government? Well, of course, this year, or this year's shutdown, right, is getting to be almost annually, right? The BIA is staying open. So it's not affecting our transactions here that are involving Indian lease land that has to have BIA approval before we can close it. Those are not being impacted, which is very good news here, because that was a problem, a very serious problem at times in the past.
Why do you think the I mean, I have my feelings about this, but why do you think the media continues to churn up these stories that really are irrelevant to the industry? And even as you say, these are headlines that you've seen kind of regurgitated over and over that absolutely have no meaning in today's world. Why do you think they do this?
I'm at a loss, Jeff. I don't understand what the motivation would be. I mean, at least if you're going to talk about the mortgage business in 2025, I mean, some of this that's being written, they ought to maybe go knock on a major, residential mortgage lender. I mean, Rocket Mortgage or somebody, or a local broker like us, and we can show you, look, everything's pretty much normal. Yeah. So it's not doom and gloom. Now, obviously, you don't want this thing to drag out, and it is going to, negatively affect a lot of people who are, they're compensated and work for the federal government in some fashion, and they could be, financially harmed by this. So we want to end it as quick as possible. But in the meantime, at least in our, little portion of the economy, the mortgage industry, things are pretty much going as usual, and there's really not been anything in the way of significant delays at all that we can see. So,
well, if you look at if you look at this whole shutdown thing, sometimes we say, it's good for one side, but it's bad for the other. And when it's bad for the other, it could be good for. Are there any good and bads or pros and cons for people thinking, hey, I'm a homeowner and I want to refinance or get a HELOC, something of that nature, or somebody buying? Are there any positive or negatives during this because of the shutdown that you see?
Well, I do. A couple things. First of all, if you own a home, it's not government shutdown directly, in the case, but one of the things that happens is, in this kind of environment, especially if it drags on a little bit, consumer sentiment gets to be, it starts declining, and we have any kind of little tinges of things are slowing down. People are kind of going into paralyzed motion and not spending money suddenly and so forth. That could, if the market reads that, the bond market in particular, that could help bond yields drop. It's that bad news is good news thing. And so if you've been contemplating a refi and you think, well, it's a little better, but I want to get that extra eighth or quarter, we may be on the verge of a period of time where you should just grab that. Because I'm not sure it's going to sustain itself, because, at some point the shutdowns are going to be over, and then the markets are going to start to focus on other data points, other factors, and this will be past history and everybody will forget about it. But at the moment, it could provide you an opportunity, if you're looking at potentially doing a refi, take advantage of what is there. It's a little bit better than it was. And then, of course, if you're already on a HELOC, you're enjoying this. The quarter we just had, the two more quarters that are projected with pretty high probabilities now that that's going to happen. That's 0.75% in the last 4 months. So for a HELOC borrower, you're happy about that. And you've got, the hope that it's going to get a little bit better with further cuts in 26 and 27. And then as well, if you've been thinking about a HELOC, now may be the time to do it, because you're going to grab it at a period where you're going to see almost immediate reductions in that rate from what you initially got. Why wouldn't you go ahead and time it and do it now, and then see how far down you're going to ride? Because there's a belief that where the Fed's target Fed funds, 4.25%, they want to get it down to around 3. So, that's a percent, 1.25% that could happen here in the, pretty relatively short period of time. That might be worth taking a look at. Then if you're a buyer, see, this kind of government shutdown headline bad news can get people kind of depressed, and there could be people out there who are thinking, oh, I want to buy a home. Oh, wait a minute, government shutdown. I don't think now's a good time to buy a home, because I'm sure that's going to mean something bad for the economy or what have you, and that I'm fearful. So I don't want to do it well, in my way of thinking, do the 180-degree theory. If that's what most people are thinking, go the other way. If you got a market that's starting to get jittery because of this shutdown, on the buyer side, that could be suddenly there's fewer buyers because they're hesitant. For those of you who feel like you're pretty, secure in your situation, your family situation, your employment situation, your income situation, if you feel secure about that, and you've been on the fence about buying, and you're like to the point where you got to buy something, maybe for very specific reasons, gee whiz, get out there now, because I think you're going to see less competition. And less competition is going to help you negotiate a better offer in most cases.
Is that with that the less competition, then that the seller is more open to negotiation as well because they're seeing less traffic?
Exactly. So that's the seller side of things. They're going to, what better barometer, if you will, of buyer demand than sellers, because they've got their homes active on the market. Most of them you're able to view with the help of your agent as the buyer or prospective buyer. They do open houses all the time. So the sellers are very tuned in to what's going on with buyer psychology. And if these government shutdown situations, and this one in particular, and if it drags on, that could start to affect buyer psychology. So those brave enough and are secure enough in their economic situation to look past that, get out there and buy now, because you're going to have more negotiating leverage. On the seller side, they're going to end up probably helping that buyer find out that's true, because they're getting nervous that their homes have been lingering on the market longer. Days on markets have been going out a little bit. And so if they're seeing that lack of buyer demand, they're going to be more willing to be open to negotiation, which of course, those combination of things that we're seeing right now, what do you think I'm going to bring up? Take advantage of getting a seller concession in dollars, not in price. Let us show you how to use it toward your financing. Buy down your rate permanently, do a 3-2-1 or a 2-1 temporary buy down, pay some or all your closing costs, or a combination of all that. That's what buyers should be doing in this market with this kind of psychology going on. And there's some deals to be had out there. And sellers, pay attention to those offers, because while it seems like a lot, it really isn't, relatively speaking. If it's close to what your average sell price to list price is anyway, consider it strongly, and in most cases, take advantage of it, get your home sold. I think right now is a good environment for all that to occur.
One last question on that, Art. Is this having any impact on tightening of restrictions on loans? Like they're being a little bit more critical of loans, and the rates are not the rates, but the let's say the FICO scores, things of that nature, are being looked at harder. Has any of this shutdown impacted that, or is it pretty much business as usual?
Haven't seen much any of that. To the extent that there would be any impact, it would be more directly on more of a loan level, what we call a loan level basis, where an individual loan file might reflect borrowers who are employees of certain government agencies that would be easily identified as being, not open, shut down. So that could be a factor in terms of closer look at the income situation for borrowers who are employed in those departments, those agencies that are going to be directly affected. Other than that, no, there's really not been any extra scrutiny. In certain things, there's no subjectivity about them anymore anyway, like credit history. Your score is your score. Mm-hmm. So, if you're 779, you're 779. The underwriter doesn't look at that more, strongly, or maybe not as strongly as they otherwise should rely upon it for. because that just isn't done anymore. It's your score is your score. And what's going to be frustrating is, 780 is the minimum for the best pricing tier on a conforming conventional loan. Well, if you're at 779, 1 point, you miss that.
Ooh.
So, and there's no exceptions. You can't say, well, gee, I'm really 77. I'm really 779 and a half, but you can't see that because it always rounds down. No. I mean, you could beg and plead. It's just you're 779. So your loan's going to be priced at that second tier pricing level because you missed it by 1 point. The response from a lender is going to be, well, go get your credit score higher and then come back. So, yeah.
Well, two shout outs before we move on. One is if you're a buyer or a seller or a refinance, this is a good time to still take advantage. It hasn't had much of an impact, but there are some pros for each side of the aisle that could help you. The second part is I would love for someone to reach out to Art that's in the media and ask some of these questions so Art can kind of, I'm going to say, debunk some of the long-standing myths or things that used to be true. And instead of investigating and finding out, are they accurate today, they just kind of regurgitate it and put a new date on it. And we think that's the fact. I'd love for them to reach out to Art and say, hey, what's really happening in the mortgage industry? I don't know anybody that has more of a depth of knowledge and on top of this stuff as you do. So I just hope somebody out there will say, hey, you know what? This Art guy, he's on top of it at Mortgage Minute. Let me reach out to him and see what's going on. So
sure.
The second one I want to talk about is a type of loan. And I was fortunate. I was in a group this past week, and you talked about something called a piggyback loan. What are they, and what problem do they solve, Art?
Yeah, it's an interesting question because this is a product. It kind of reminds me of the buy downs, right? The temporary buy downs that we've talked about forever. Piggyback loans are in the similar category in the sense they've been around for decades. But as is always the case, the mortgage market, real estate market changes over time. The popular loan options and fads change over time and so forth. And the problems to be solved financially can change. The piggyback loan is one that involves they're primarily used for a purchase, not for a refi. And the idea is with a piggyback loan is that you've made basically a conscious strategic decision that after applying whatever amount you have available for down payment funds, that you're going to take the remaining portion of the financing and you're going to split it up into two loans. So that's where the term piggyback comes from, is because, of course, mortgage loans go in, priority recording order. So you have a first trust deed, right? A first mortgage, we call it generically a first mortgage because we're actually in a trust deed state in California. But first mortgage. If you have a second loan, that's a junior lien, or a second mortgage, you can have a third lien, third mortgage, and so on. So the idea is with a piggyback, you're going to take your total amount of financing you need, split it up between two loans rather than having one. And a portion of that's going to be your first mortgage and a portion of that's going to be your second mortgage. So that's why, piggyback, one loan piggybacks on the other.
Okay.
So then the question is, well, why was this even created? And way back when, I would say the basic reason or the primary reason piggybacks were considered, and this was in part a marketing effort by second mortgage lenders, or equity loan lenders who were trying to drum up business. Like, hey, we want to make more loans. And gee whiz, the problem with that is when the mortgage market developed where people could buy and finance a home with a loan at higher and higher loan to values, then they could get a single loan with 3.5% down, FHA, conventional loan with 5% down and get a 95% loan.
Wow. So
forth. So the second mortgage lenders figured out that they needed to promote an alternative to one of the sort of evil outcomes of putting less than 20% down and getting a single loan, and that is mortgage insurance. So the idea was, and again, mortgage insurance can confuse people. A PMI is private mortgage insurance. That's insurance that is put onto conventional conforming loans. That is, loans that are not insured or guaranteed by the government. Then you have mortgage insurance. FHA's version is called mutual mortgage insurance, and that is insurance on a federally insured mortgage, again through FHA. So two different types of mortgage insurance. PMI is private, meaning not FHA, not VA, private, conventional. That's what it's for. So the idea was, if you put 5% down conventional or 10% down, and particularly if you had lower credit score, your PMI cost, private mortgage insurance cost, could get quite expensive. And so PMI kind of got a bad rap, and the focus was to try to, how do we get around this PMI cost? So here comes the equity loan industry. Hey, we have an idea. Buy your home. Yeah, go ahead and still put 5% down, but split up your financing between a first at 80%, where there's no PMI required, and then we'll provide a second mortgage for 15% of the price, and then you put down your 5%. Ergo, no PMI cost, because there's no PMI coverage required, because the first mortgage is at 80%, and second mortgage, because they're in junior lien position anyway, they tended to be at higher combined loan to value, given the nature of the type of lending they do. They don't have mortgage insurance on those loans. It's basically built into the rate. That's why a second mortgage rate is always higher than a first mortgage rate, in part for that reason. It's junior in priority, and it is typically going to be at a higher combined loan to value when added to the first. So that was the initial, discovery of a new financing tool, predominantly used to get rid of or avoid mortgage insurance by splitting up your financing between two loans. So, and that worked for quite a long time. But in recent years, PMI has gotten, I think, better in terms of managing their risk. I think PMI overall is, I would call it less expensive than it was, at least relatively speaking, when you consider higher, median loan prices and purchase prices of homes and so forth. And so the whole piggyback to get rid of or avoid PMI kind of fizzled away and just hasn't been a major part of the market. Now, all that said, where I think a piggyback has got great application, particularly in some markets like ours here in the Coachella Valley. Give you a real life example. We just started this deal last week. Family in Seattle. They've decided they're moving to Palm Springs. Their home they think is worth $1 million. They're looking at a home in Palm Springs for about $1.2 million. Both employed, very high wage earners, income not an issue. They have money available for the down payment for the purchase loan without having to wait for the proceeds from the sale of their current home. And their current home has lots of equity, $1 million home with about a $250,000 mortgage. So they are able to buy the purchase home non-contingent. They don't have to sell the current home to close on the purchase side. I pre-qualified them that way. They negotiated a purchase to do that. So they opened escrow, buying this home for $1,240,000. They're putting $300,000 down, actually $340,000 down, or 25% down. And then we're going to take the remaining financing amount, $940,000, and we're splitting it into a first mortgage for $210,000 and a HELOC second mortgage for $730,000.
Oh.
And that's not by accident. The estimated sale proceeds they got from their realtor for their home in Seattle, which is now also in escrow, $730,000. So the idea here is we're going to close and these are going to end up closing like within a day or two of each other. I can't say, well, let's not do the HELOC because you're about to close your house anyway. You'll get your $730,000. That's just more down payment. Why get the HELOC? Well, two reasons why we're not doing that. First of all, their offer was accepted based on non-contingency of selling their current home. So they are not allowed to wait for the home to sell, to close the sale a day or two later. They got to be prepared to close on their close of escrow date, which is sooner than their sale close of escrow date. So they have to close. So the idea was set up the HELOC for the same amount of their proceeds, We close the purchase with 2 loans, and then a day or two later, or it turns out if it's a week later, they close on their sale, take their sale proceeds, pay off the HELOC.
Oh,
Now they're left with what they wanted long-term anyway, which is they wanted a smaller loan net of once they get their current home sold and the proceeds applied toward the purchase house. Originally, we were just going to do a loan for $940, and I pointed out to them, look, you can apply $730,000 of proceeds toward this $940 loan, but your payment's still going to be based on the $940 loan amount.
It doesn't reset.
It doesn't reset. Yeah, it doesn't reset.
Okay.
It doesn't recast. Right. So you're going to be a 210 balance paying this huge $940 payment.
Wow.
This is a way to address that problem. Now, it's true, some lenders, more bank-oriented credit unions, I think there is a process where you can apply to maybe get them to recast it. But they actually like the idea of doing it this way anyway, in part because that 730 HELOC, once it's paid off, it's going to sit there unused but open. So if they need to tap into some quick funds for any other reason, they got nearly $750,000 sitting there ready to use the credit card they give you with it, or the checkbook. So
at a really good rate.
Yeah, it's a prime plus a quarter.
Wow.
7.5. And
That's
that
really
means by the end of the year, what we talked about earlier, they could be at 7.
That's really great, Art. What a good idea.
And then when it's paid off, there's no interest accruing because it's a zero balance, and yet they can access it anytime.
Wow. So just because they pay it off, it doesn't mean it closes it out. It just zeroes the balance, and it's there for how long do they have an access for that then?
This particular one has a 5-year draw period. So for 5 years, it's sitting there, no interest accruing unless they have a balance. If no balance, then they wait and just use it when they need money.
Wow, what a great idea. What a great idea, Art. That's brilliant. So that's called a piggyback loan.
Yes, a piggyback.
Yeah. I love that. Well, let's get into this last piece, which is now loan registration and initial disclosure, including LE. Why all the confusion? First of all, what is this you're talking about?
Yeah, I wanted to touch on it quick because I deal with this probably more than anything else in the loan process, including a new customer, actually a past customer. We're doing a new loan for him on a refi, actually, and he was getting confused about the initial disclosures. First of all, to cover the issue very quickly. First of all, as I've mentioned before on this show, when I encounter a new customer or even a past customer we're going to start a new transaction with, very first thing up front, top of mind, you're going to see numbers first. You're going to get a worksheet from me based on parameters you either give me or based on the ones I had on you from before, only subject to getting an idea what your current credit score is now. And we usually start off with just relying on what the borrower tells us, letting them know it's subject to change if they're wrong. So then I can give them some specific numbers even before we start the process. So then they've already got written numbers. It's on a closing cost, one sheet, piece of paper worksheet, different than an LE, which I'll mention here in just a second what that is. So we move forward. We're going to register your file with a lender. And when we do that, there is a regulatory requirement that the borrower must receive initial disclosures, including an official LE, which stands for loan estimate. That was a form created by the CFPB back in 2010. So it's a regulatory requirement that the borrower receive that package within 3 business days from the date of registration with the lender. So when we finish that registration, they're going to get an email from the lender we registered their file with the initial disclosures. And they're provided instructions to open the disclosures and sign them, basically e-sign them all. It's in most cases a very simple process. And I would say a majority of borrowers, not a great majority, the majority of borrowers seem to handle that process fine and can get it done with no problems. But we do have more than a few, but not a majority, who struggle with the process for various reasons. And one of the big parts of the process that really gets people kind of wound up is the LE document itself. It's typically about 3 to 5 pages out of what is generally going to be a 100-page disclosure package. It's a lot of paper. Of course, all on the screen is what you're looking at because you're encouraged to do it online. you can have the package, snail mail to you, and you can sign it all manually. But we really discourage people from that unless they really, really want to, take that approach. Anyway, so here's the problem, and it's something I've kind of groaned about in the industry for years. This 3-day rule, because when this LE goes out, it's a loan estimate, so it has specific figures. Now it's going to have your loan amount. You're going to be able to determine what your down payment is from the form. It'll have a rate on it, but it's going to have an itemization of all closing costs. Now, what do I mean by all closing costs? Appraisal fee, escrow fee, VOE fee, notary fee, the escrow or settlement fee, the lender's title policy fee, the recording service fee, blah, 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 blah. Most of which, by the way, are being charged by the escrow and title companies, not us, the lender or the mortgage broker. So those are all on this form. And again, it's going out within 3 days. It has to be signed to move forward with additional steps in the loan process, underwriting and ordering the appraisal. So the fundamental problem is usually when at that date of registration, and even within that first 24 to 48 hours, we often don't know who the escrow company is or who the title company is or what their fees are. And yet me as the originator have to send a file to the lender to be registered with all fees estimated, even though all of the fees I'm estimating are not mine. They're not MortgageWorks. In fact, that's one point. I'll digress. Everyone watching and listening, we don't charge fees on our mortgage originations ever. We never have in 28 years. We never will. So we have no junk fees at all. So with that put in place there. So here's the problem. So how do you get around that from a regulatory standpoint? Because each fee, depending on what type of fee it is, there's a regulatory tolerance limit as to how far off you can be off. Some, like the origination fee, the lender's underwriting fee, no tolerance. You cannot, it has to be exactly what is quoted. Now with other fees, there can be a 10% tolerance. And with other fees, there's no tolerance because it's understood they can change, like your homeowner's insurance premium that we're estimating up front and a few other things like that. So what that means is these lenders, we all had to come up with a different way to solve the problem. Well, the way the lenders do this is, and I'll use one in particular, they call it their smart fees. So when we register the file, it'll say, do you want to use smart fees? We say yes. What that does is it populates this loan estimate with basically fees from a predetermined, pre-designed template of fees based on certain loan amount levels and purchase price or home value levels. So basically just a pre-made set of fees. Again, this particular lender calls it smart fees. And they also just populate the LE with the name of an escrow and title company that 99% of the time is not the one that's going to be handling your transaction. That's important, though, because by doing that, escrow and title fees are allowed to change based on shopping around. They're considered a fee that you can shop around for, even though almost no one ever does that. But because it's allowed to shop around, there is no fee tolerance as long as the actual provider is not the same company named in your LE. Okay. So you're off the hook there because almost always we meet that test. Who's actually going to be chosen by the realtors in the transaction is not the one pre-populated in the LE by the lender's smart fee schedule, right? And then the same thing with all the rest of the fees. So here's the problem. They overpopulate the LE with more fees than are actually going to be charged. Like, how about this? Owner's title policy on a refi. There is no, that's a fee charge on a purchase, not a refi. Or a transfer tax, $2,000. Again, that's on a purchase, not on a refi. So I had a refi LE go out as part of one of these disclosures with those kind of fees on there and other fees that were inflated way high. But understand that that is on purpose. It's to avoid under disclosure where penalties can be severe. So what you all have to understand, whether you're getting a loan from us or any other lender, mortgage broker, what have you, don't panic when you see that LE with your initial disclosures. It's a good faith effort to try to guesstimate the fees that you will be charged. And that guesstimate is being provided primarily by people like us, the mortgage loan originator, who is put in the position of having to give you a relatively accurate estimate without having a clue who's going to provide these services and what they're going to charge, because we get that information later.
Wow.
So that's why I always say, first of all, it's a loan estimate. It doesn't commit you to anything. So signing it doesn't mean you're stuck with those numbers you see, not at all. So that's why it feels weird to say it, and I have to tell people all the time, ignore what you're looking at and just sign the documents. Why? Because that starts that next period of time that allows the next step in the process, getting your loan underwritten, getting your loan, your appraisal ordered, and moving along in the process. So it's important. Get on it right away. Sign it all. Don't get mucked up in the LE numbers. Go back to your loan originator. Have some more discussion. We will do that for you and show you what's right, what's not right. And your own loan originator, if it's somebody else, should be able to do the same. Don't get worked up on this. Keep the process moving. Sign away. You'll be safe. After all, most of those disclosures are designed to protect the borrower anyway. So you always have to keep that in the back of your mind. These are generally for your protection, not to trick you. That's not what they're about.
Art, this is a wild situation you have to deal with every loan that you originate, whether it's a purchase or it's a HELOC. Right. I'm curious, do you get the opportunity to disclose the disclosures? Because it sounds like they come from the lender, not you.
Well, right, they do. Yes, and yes, we do have the option. And see, this is where I'll admit, we're probably a little bit guilty of what, as you probably can surmise from what I describe, it's really kind of a nutty process, right? It's kind of like, why is 3 days so magical? Why don't we make it 5 days? That way we can be assured of getting to find out who the escrow provider is and get their actual fees, so we can populate the actual fees at the beginning rather than something that's way off and then we have to fix it later. Yeah. But I'll plead guilty that when these lenders, early on with this process, that's what we had to do. And it was very laborious. You had to go through, and we're still stuck with having to guesstimate because, again, we don't know who the escrow and title company are in most cases. Or even if we do know what they are, and even if we've requested their fees, it can take them 2 or 3 days to get them to us. So we have to put something in there to keep the process moving. So, we still feel the burden. And so, frankly, when lenders started seeing the problem with that, the manual input of all these individual fees, and particularly coming from a position of fear, because if you're off by $2, you're going to get, $1,000 penalty because you exceeded the 10% tolerance, whatever. I'm exaggerating, of course, but the point is that was very inefficient. So I think it was a good thing that they came up with these templates, these smart fees, as this one lender calls it, because it's an easier way to get the process going. So sure. We always, if they offer a template, we're going to choose it. And so where I spend my effort is to alert my customer of everything I just described, so they know when they get the package, it says $3,000, transfer fee on my refinance loan. Well, Art said to ignore it, so I'm just going to sign. And that's what we do. I just feel like that, and frankly, it's better anyway. It gives me more opportunity to interact with my client, to reassure them about the process. So I think it's a healthy thing. I'd rather, reach out and explain this nutty little nutty thing to do. And we should do a video on it, by the way, Jeff. Yeah. It's just an inefficient process, but it's one that, as long as you understand the bigger picture, nothing to worry about. Let's just keep the process moving. So
you said not quite half of the people who get these disclosures will still have a problem because they'll be confused. Because let's face it, as you said, they could be getting a 100-page document and it's electronic, and all of a sudden now everything's overpopulated. Even though you told them, they might have forgotten because now there's a bit of overwhelm. How many of those people are you dealing with that you have to go back then and basically talk them off the ledge?
Well, I mean, if I was to put a number to it, I would say it's somewhere between a quarter and a third of our customers, we have to go over that part of the process. Well, there's one I just described. It's real live. It's just a couple of days ago, and this is a past customer of mine. I mean, I arranged this previous loan in I think it was 2022 or something, or 21. But it was the same thing, when he first reached out, said he wanted to refi. We discussed what he wanted to achieve. So I put it together a worksheet, sent it to him. And with my worksheets, I am, despite, me playing the victim, that I'm having to disclose fees for people I don't know who are going to handle the deal. On a refi, we do, as a mortgage broker, we have the ability to choose the provider.
Okay.
Not on a purchase. On purchase, it's all about the realtors and the seller and all that. On a refi, we get to choose in most cases. That's good because then I know who I'm likely to place that refi with, and I have a pretty good idea of their fees because I do business with them on a regular basis. So that's how I started with him. Gave him a worksheet. He looked at it. He was fine. Good to go. Let's proceed. So then he gets the disclosure package. And of course, I get an email from him. Why did the closing costs suddenly go from $7,000 to $15,000? So I, copied the page of the LE, resent my worksheet, and on the LE, I marked it all up to where this doesn't apply, this doesn't apply, this doesn't apply, this is overstated. Sent it back to him, and then it was like, oh, okay, I remember now.
Yeah.
So he was fine, but yeah, we have to do that quite often.
And for us on the outside, we just think there's no drama in your world.
Yeah, I wish. If there was no drama, I'd still have hair.
Oh my gosh. Well, Art, this has been a great conversation today. The good news is, and I'm going to bring it back up on the screen here real quick, is Art is still open. He's still doing his thing. He's making loans, helping people get in their homes, get their refinances done. I guess you're probably still doing reverse mortgages for people as well, right?
Correct. We got a couple going right now. Yep.
So make sure to reach out to Art. And Art, thank you. I really appreciate it. I'm going to turn it back over to you.
All right. Thanks, Jeff. Again, thank you everyone for watching and listening to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Looking forward to some playoff baseball later today and over the weekend. So we'll see what happens there. In the meantime, have a good weekend, and we'll see you next week on another edition of the Mortgage Minute. So long. Take care.